Hey, good morning, everybody. Happy Thursday. This is the morning show here on Stock Market TV. You got me, Spencer. You got Steve, Strazza, JC back tomorrow. Funny line in the chat. Do we think it's possible that when JC is back tomorrow, the market is just right back where he was when he left? I mean, actually, kind of, yeah, right. That'd be pretty funny. What could we possibly have to talk about today? Don't know. It's not like we didn't just get one of the best days ever, which, credit to us, Steve and myself, we said this was going to happen. We didn't know when, we didn't know why, but it was going to happen. It happened. Now what? Now we discuss. So that's what we'll do today. We'll have Mike Singleton on the show. We'll have Kenny Glick. And then as a reminder, as we've been doing all week, we will end the show at 9:30. Strazza will pop back on at 9:45, do a little bit of stuff after the open, and that'll be what we got today. Sean might be there as well. So, chat, are we all good? Yes? Capiche? Capiche. Let's go.
I believe actually what was said, Spencer, yesterday about 9 minutes into the show was that if China doesn't want to play ball, that the US is just going to team up with the rest of the world and crush them. And then you said that's assuming
I said they would have to get everybody else on their side.
Is going to be on our side. Like that's some sort of crazy thinking. I'll tell you right now, I'm trying to remain incredibly objective about this. I think I always do a pretty good job at that. Right now, as it stands, looks masterful on the side of the United States. And I think it's awesome. And I also think that anybody out there on Twitter who's not rooting for their country to win in these global trade negotiations is simply out of fucking touch. And I'm sick of it. It's disgusting. Imagine rooting against your own country and your own personal prosperity. It's ignorant.
Yeah, I don't like that. I'm sure there are people are doing that, but also maybe there are just people that are like, why did we even start this trade war in the first place, right? So they're maybe not loving just the principle of it, right? Not so much. Yeah, obviously we all want America to win whatever we're doing, right?
I'll tell you something about 99% of those people complaining about why did we ever start the trade war in the first place. They don't know the first thing about global trade. Ask them what the current tariffs are and why it's fair. Nobody knows any of these details, but everybody has an opinion. People are stupid.
Well, all I know is that we said last week, right, when this whole thing started. Was it last week? I guess it was last week. Time is slowing down now. I don't even know, or speeding up. We're gonna get a face ripper day. It's gonna be like the best day since 2008, best day since whatever, right?
Really?
Don't know when that was gonna happen.
I feel like I've been writing Spencer for like 3 days now. It's just around the corner. We're one green close away. Like it did take a while from how.
No, it didn't. It took 4 days.
Dude, I mean, Spencer, we came off extreme oversold conditions. And we say this all the time, right? It's not just stocks, but volatility, when it spikes, the short-term volatility, it's not just one way. It always goes both ways. Right, biggest up days, biggest down days. This kind of action happens at inflection points, whether it's short-term bottoms, long-term bottoms. This is some sort of bottom. I think this is by far, I mean, we have a ton of charts that we'll talk about, but you have the all clear signal for now. I think you could trade the hell out of this, but there is a very, very important environmental caveat that I want to talk about to this rally.
It's not over. This isn't over, Steve, right? One green day does not make a trend, right? So There will be more. There will be more.
Oh no, it's the starting line momentum that you want to see. I think we easily go higher from here. It will be worth trading. What I don't think is going to happen is we're just going to go right back to all-time highs. I don't think it's going to be like an August situation. I think you're getting a V right back. Okay.
Yeah.
There was a lot of damage. And when you look at this was one of the best days in market history.
Mm-hmm.
You know this, right? Throw up these charts. Funds.
We got one second.
S&P 500. One of the best days in market history. The forward returns are fantastic. You could go find all the statisticians on Twitter talking about it. Right. However, look at where these days tend to occur. And you know where the other ones were?
Where? Yeah,
So
like 87, no, 08.
No. So if we're looking at the S&P 500, you would have to go all the way back to 1929, 1931, 1932, 1931. You had two in October of 2008. The problem with the big up day in October of 2008, there was a tradable bounce from there. Then the market rolled back over, fell another 25%. And if you throw up the NASDAQ 100, right, look what happened during the dot-com bubble.
Yeah.
Absolute banger. But guess what? After, again, a very tradable rally, market fell 75%. NASDAQ 100 fell 75% after that. So I think that this bounce, while it will be fierce, it already has been fierce. It was awesome yesterday. I think it'll be counter trend in nature. What do you think about that?
I'm inclined to agree. I mean, what did we get yesterday? We got a headline that the tariffs that were announced last week have been delayed. Most of them were delayed for 90 days. So what does that really mean? That means that we have at least 90 more days of this BS, right? That's what that means to me.
We're moving in the right direction. And I also think it's incredibly positive for the United States and United States companies. You know how I traded yesterday on the news? I didn't have the time to figure out who the winners or losers would be. Went straight to the Mag 7s. Straight to the Mag 7s. Why not? Why overcomplicate it?
There were no losers yesterday, to my knowledge.
10 stocks were down. Throw up the table. Great point, Spencer. And this is what I'm talking about, right? Breath was just what a banger yesterday. Throw up the table of the AD. Yeah. Okay. Nothing was down in the mid cap world. Zero. See that? Look at the first column there. Look at the first column. Pretty good,
dude. Imagine being one of those 9.
Look at this though. This is just incredible, right? This is how tradable lows happen, right? This kind of just huge breath swinging in both directions, right? And we'll talk about the oversold readings too in a minute. And we'll talk about the percentage of stocks below the 200-day in a minute as well. These are washout readings. We had a lot of signals of exhaustion. Then we had one of the best days in market history off of that exhaustion. That's it. That's all you need to know. From a technical perspective, green light for now. We went from 490 stocks down in the S&P 500 just a couple days ago. And then we had a 430 stocks down day following it to 490 up. Now show the percentage of stocks above the 200-day indicator. Okay. So we went from, no, this is overbought, oversold.
Oh, wait.
Give me the 200.
Did I go the wrong way? Wait, where's the 200-day?
It's by the chart. It's the table.
Oh, wait, my bad. Back one more. Back one more. We're good.
No, but I want the table.
I don't think we have. I don't have a table.
That's it.
Oh, nice.
So look, S&P 500 didn't quite get to that 15%. S&P 1500 did. Because the smalls and the mids did. So if you look at the bottom two like matrices here, the mids and the smalls, we went from 10% of stocks being above the 200-day, we spiked back to like 22%. And the S&P 500 spiked back to about 30% just in one day's action. And then you saw smalls go from 10 to 15. That's another bullish initiation signal, right? A little tradable bottom, or a lot of times it's actually the primary trend bottom. Go show this chart. So this chart depicts what I'm describing in this table here. So you can see what a good signal this is. Probably one of my favorites for identifying bottoms. Obviously, you complement this with some other tools, right? Like breadth and intermarket stuff. Can we show the chart, please? CPI is kind of irrelevant in this market, isn't it? You know who's irrelevant too? I was saying, am I talking to myself? Can we show
No.
the chart? Were you not listening to me? Okay. You know what else has been irrelevant? I was saying to Spencer the other day. What are you laughing at? The Fed.
Nothing.
The Fed has nothing for this market.
I know. I've seen some great memes. But of like people fighting, whatever, and then there's one dude sitting away from the fight, and that one dude is Jerome Powell, right?
Yeah.
Because because
No.
what's he gonna do, right?
This is unique in that way, right? Spencer, think about it. Whenever you get market crash, market volatility, like we've just had, the Fed's at the forefront of it. We're talking about them all day, every day. Not this time.
Yeah,
not this time. So here it is. So you can see going all the way back to the great financial crisis. Once this drops below 15% and then recovers, it's the recovery, Spencer. It's the recovery back above 15. Pay attention. Like I said, this is the S&P 1500. And beware of a double dipper. You get a double dipper every now and then. Right? The double dips happen. You see it a couple times here. So that just means a retest. Right? Do we get a little retest, a little backing and filling after this automatic reaction? I think so, probably. So that's really what I wanted to go over here today. We've been saying, look out, we're probably gonna rip any day now. It's gonna be a historic face ripping rally.
It was.
And you got it. And I don't think it's over yet. I think look out for Europe, man. And I'll also say another thing about China. I know you don't like my take about maybe a potentially massive valuation headwind being removed, with China making some sort of more sustainable deal with the United States and really the rest of the world. At this point, it's China versus world now. I think Chinese stocks, they're at the forefront of this right now. Like I said, China versus world. Look at the price action in China yesterday. It's already priced in.
Now China is ground zero for this stuff, right? Because they were the one. Everyone gets a nice little 90-day reprieve, right? Except for them. Funny how that works. But
the stocks are not falling. And frankly, if you look at the selling that's happened everywhere else through this tariff tantrum, Spencer, China hasn't been so bad at all. Maybe not relative strength.
You're right. You're right about that. Yeah.
Stocks haven't collapsed. You could draw a trend line. Go draw a trend line from early last year's lows in FXI. It's holding trend. There's nothing crazy going on with the selling in China. This is orderly. This is just a little corrective wave. You buy this. This is like the corrective wave that we got last year, at the end of last year, after all the momentum thrusts in China. I haven't sold a single share of common stock in Chinese equities.
Wait, yes, you did last year.
Not through this.
Oh, well, so whatever you had a few months ago, you still have? Okay.
Yeah. I've sold no China. We've put on some shorts.
Look, we
hedged a bit of China.
What did we say? What did we say was the biggest risk for bears? It was the exact headline you got yesterday. It was wait, timeout, pause, never mind, oops. Right? That was the risk.
And we talked about how the market wanted it so bad. You saw
it. We saw it on whatever Monday, right?
Monday and Tuesday. The market's rallying on nothing. We had these hope rallies, these rumor rallies. Market was like, just give it to me. And then yesterday, everybody knew it was happening too, and the market was running it. Like a word got out. And I guess it turns out that pay attention to Donald Trump's Twitter. That was pretty cool. I thought that was funny. So he kind of tipped everybody off, like, buy stocks, it's coming. So Scott Bessent, is supposed to go and have some fancy meeting in front of the Congress, something like it was like the Republican Book Club or something. And he has to emergency cancel his meeting for an emergency meeting with Trump. Yeah. So the markets freeze up. They're doing the emergency headlines here. And then all of a sudden the announcement comes out.
Yeah.
And Trump actually came on afterwards, did a little presser. And he said, I put it in the morning show chat. What did he say? Basically, Spencer, he said the same kind of sentiment we were echoing here on the show just yesterday. I typed it into the chat. Oh, and the sell side is hilarious. China doesn't know quite how to make a deal, but they want to. They are a proud people.
They are. They have. They got more national pride than probably any other country out there. Maybe the North Koreans, right?
And everybody's like, oh, but what about Europe? Why aren't you being mean to Europe? You see what Europe did?
Yeah.
It's not about you, Europe. It's got nothing to do with you. It never does. No offense.
Dude, yeah.
And then Goldman Sachs tripping all over themselves.
Goldman Sachs. Life comes at you. Life comes at you really fast. Is all I can say. I don't envy them. They're not in a. This is not a good spot to be in. They've got to put stuff. They have to put stuff out. This is what they are paid for. It's what their clients expect. They need to have opinions. It's their job to have expertise on this stuff. So they do what they do. And then, oh shit, 73 minutes after they publish one note, they publish another note saying, actually, never mind about the whole recession thing. Yeah.
Fuck. They can't enjoy a Trump presidency. And you're right, Spencer. I tend to agree with you on this. If Big Man was here, he'd be roasting them for this.
It's not their fault.
What are they gonna do?
It's not their fault. So I mean, I sympathize or I empathize. I don't know which is which. I do one of those things.
So they made a recession call for an hour and 15 minutes. Is that right?
Pretty much.
Wow. You know, I was actually Samaki. Steve, are you moving toward recession in USA? So I was at Future Proof, whenever it was, a couple weeks ago, and someone interviewed me there, just asking, some broad, basic questions about the market and the economy. One of the questions was, when is USA going to have another recession? I said, we might be going into one like right now. And then he said, oh, why? And my answer was, because I'm a technical analyst, right? So my answer was,
the market always jumps it.
My answer was, it's been a while.
It's been a while.
And everybody laughed. So yeah, I think so. I think we're going into an earnings recession. I think the market's been telling us that. I think you've been seeing it reflected in the earnings trends for 2 quarters now.
I think I've seen the charts too. The market not every time, but usually bottoms right before other things bottom. Right, it bottoms before earnings bottom or GDP or whatever you want to measure. Right, not every time, usually. Yeah. Right. So, and then what does it do after it bottoms? Well, it can only go one way if it's a bottom, right? It can only go up. So, yeah.
Call it forward looking. They say it's one of the greatest discounting mechanisms in the history of man. The market.
Look, I'm inclined to agree. On a day like yesterday, when everything on your screen just turns on a dime, and rips like that, trying to, just making sense of anything is not a good use of your time. You just look at the charts, right? Let them be your guide. This is why I have, like, for my own personal stuff, Steve, you've been pounding the table on being bearish now for, I don't know, 8-12 weeks at this point. I was a little bit slower to the game than you, but I am sitting on a decent amount of cash right now. What I do is I figure out, I sit down, I say, okay, how much do I have? How much do I want to invest? What do I want to buy? And then when am I going to do so? And for me, it's usually based on time. That's just like the easiest way for me to emotionally. That's how I survived. Survive is the wrong word. That's how I correctly allocated through the COVID crash. Right. Yeah. I just said, okay, every 2 weeks, I'm buying X of that, Y of that, Z of that, and I did that until I had no more money to invest. Right. And that's what I'm doing now. It's the same exact thing. It's every. Now it's going to be every week for me, right? But like every week, right? And then I'm done. And then that's how I get through it. And I don't have to think. I don't have to do really any analysis at all. I've already kind of done that, and I'm just trying to like allocate my way back into the market. So that's what I'm doing.
That's great, and it's far better than most people. I've been, talking to a lot of friends, family members, clients lately, and that chart, the percent back above the 200-day moving average, you can use in times like these. And Spencer, it's not
That's
a
right.
question of being in the market or out of the market. It's never really going to be 100%, right? It's a matter of your allocation, right? And
That's right.
raising cash at the right times, taking profits, right, in the later stages of a trend, and then using something like this, using some sort of indicator, some data, right, some market data, to tell you when it's a good time to then start decreasing that cash allocation, right, and getting back into the market and adding risk exposure.
Yeah, like I didn't know this was gonna happen. I obviously
You never know. You never really know.
I didn't know there was gonna be a tariff tantrum. I didn't sell I sold 3 weeks ago. That was because the market had been going down. I was late to the party as far as I'm concerned, right? I was late to the party. I was late to the selling party. I wasn't as late as I could have been. I could have been later, right? So I got a little bit lucky there. But yeah, I was late. So, now I have to get back in because
How late? How late?
3 weeks ago.
I was explaining to my neighbor.
So,
Yes.
we've been going down for months.
I was explaining to my neighbor yesterday. The idea isn't to get in at the first inning and out at the ninth. I explained to him about catching the meat. I taught him about the meat, right? Because he was all worried. He's like, "Oh man, like I missed it." The market's up like 20% yesterday. Some of these Mag 7 stocks, you feel like you missed it, and it happened in the afternoon. So I explained to him it's about catching the meat, right? Those middle innings, right? Don't judge yourself and your market decisions on all or nothing. That's why scaling is helpful too. It's just helpful for your brain and your market.
Yeah.
When you scale, you don't want it to be an all or nothing. Then you anchor to, I bought everything on this day or I sold everything on that day. No, a little bit of buying, a little bit of selling, a little bit of buying, right?
It's called a regret minimization framework. I subscribe to that idea. Everything I do is designed to minimize my own second guessing and my own regret. Let's talk to Kenny Glick. I'm sure he had a wild day yesterday and has probably had a wild morning this morning. I don't know what he's done this morning, but for days like yesterday are catnip for guys like Kenny. So let's see what he did, and then we'll bring on Mike Singleton.
It's been a long time coming. They ain't come for my club, they tug it. Putting up numbers, 99 pounds, and I still kept it 100. Hola. Yeah.
Yo,
Strazza.
My friend, you have been absolutely killing it.
You are killing it with that tan. I am Tan Man. I am just Lotion Boy.
I look like a fucking tomato.
No, man, I got to get some color in my face. I'm still sitting here from yesterday. I haven't changed. I haven't moved.
Man, I wish I wasn't so busy in the morning. I'd be in your room, brother.
Kenny, I believe you. I actually believe you.
Listen, Strazza manifested that move. He's like, we're just one tweet away from a massive melt-up. And then what? Yeah, that was incredible. Incredible. But he's also, he uses all those key phrases. Meet in the middle. And again, I wish nobody was buying the low, selling the high. I mean, we were playing that chop pretty nicely yesterday, and we were just waiting for something else to happen. And then for a second, they were like, hey, maybe we just hang out here for a day or two. And then suddenly we had, I watched the volatility products. Yesterday was all about UVIX and UVXY. So you had this spike down, and I was already short the volatility products. That's the UVIX is now my new favorite toy.
Oh boy.
They weren't letting me short the UVXY. They wanted to charge $500 for 100 shares. It was just
get the hell out of here.
Yeah. But UVIX 500 shares for $25 for the borrow, very nice. And let me show you what was going on at the time. So you had this. I thought people were joking around in the chat room when they said CNBC just basically said to buy QQQ calls, and I was like, specifically, just like that. And I was like, well, that's interesting. And then we spiked up, and then it came back, and then Trump tweeted out, "You want to be buying stocks right now?" And I was like, wait a second, what the hell's going on? Are they trying to help us here, like front run something that's about to happen? And then boom, it kicked in. So as much as you might want to, again, I've been battling with, I'm right in the middle of the Trumpers and the hate for Trumper fan people and my liberals, and I'm right smack dab in the middle. And they're saying, "Oh man, he's manipulating the market." Maybe he is, and everybody does, and inside information. But in this case, he did you a favor by saying you might want to be buying right this second, and then he released the news. And I would have been upset if this would have happened overnight. So, if you're shorting volatility products and you're sitting there getting grinded up, and then the next day they're down 50%, like UVIX plummeted 50%. I woke up to see it down there after not making any money. I would have been upset. But he did us a favor and did it during market hours, and it was fantastic. And listen, I was out of that move until it broke that 443.14, because that was that double top area that we were talking about, that the first melt up, the other day. You got to the 443.14. Let me show it to you on the chart, and let me give you a 5-minute chart, or I can put it on a 10-minute chart just to crunch it up there for you. There's the 443.14. There's the 443.14. I was not even involved in this move. I was selling into the move just as it was just. I wasn't thinking we're about to go up 12%, basically. But at 443.14, I'm like, no way we breaking this price. I got to buy again. So I bought here and I sold into that first move. And again, then I'm thinking, all right, when's the reversion trade? And I was like, all right, the UVIX is crashing, UVXY is crashing. I am not shorting, because normally, I sell out and I'm like, all right, let's play the counter trend move. And there was no counter trend move until this little double top. People were saying, don't do it. I'm like, I gotta try. So I shorted some cues right here. I narrowly escaped.
Wow.
Because right there, I thought, I was like, okay, we're gonna rip right back down now. And I wound up getting stopped out, of what I had left.
That took guts.
Thankfully, yeah. People in the room were begging me not to do it.
That took serious cojones. Oh boy.
Yeah, but it was just absolutely absurd. And the funny thing is, this all started with the Delta Airlines trade. Again, we're right back into earnings season, right? And it was a wonderful trade. We made 50 cents on the airline. Again, VWAP break. You got the 1-minute multi-day VWAP reversal. If you're starting to keep track, we're 1 for 1. The trade hasn't failed us in like 2 years. VWAP breaks, multiple time frame VWAP on an earnings report. We're buying 37, selling 37.50. We're loving it. Look where that stock wound up going, $45. It's absurd, some of the numbers that you see now. And I don't know, the way I'm looking at it right now, I've already shorted the market once. I think we're going to test the 443 to the downside now. So that move was so epic that it actually needs a correction now. So I think, again, after the jobs report came out, let me show you what we did so far today. Only one trade, and so far so good. There was a little spike on the inflation data, and then it rolled back over. VWAP break. We're shorting here, using these areas as our out if we're wrong, and it pulled back to the prior low, and that's where we covered. So far so good. Days pay, and now I'm just sitting back and I'm going to wait. I'm looking at some CarMax. Some Lovesac, baby, LOVE. If you guys know this one, Lovesac reported earnings below VWAP. We're going to keep an eye on this one. But really, it's going to be the volatility products and the Qs, and it's going to be the same. It's going to be the same day over and over again. And if we could bottle these 6 days and live these last 6 days over and over again, that's my heaven. I hope
fortunately for you, Kenny, you have the next 3 weeks of earnings, so you don't have to bottle it. It's coming. So
right.
But
all right. I think there's going to be a lot of gaps and a lot of fails and a lot. I think this is going to be here for quite some time, and it is fantastic. And speaking of earnings season, speaking of all that stuff, if you guys are free tonight, we're going to be doing our schmooze. I think I might have some institutional buy side. There's a guy, Dave from Trade Ideas. He launched another company called Trade Pulse. We're having those guys on. So. The Trade Pulse guys.
Yeah. How does one get into the schmooze besides being in your room?
Give me an email. You can call me. You can email me directly. And if you don't know, it's Kenny Glick at AOL.com. That's right. 1989's in the house, baby.
Okay.
Or 1992. So Kenny Glick at AOL.com. I'll send you the link, and I'll bring you into the secret lair that I have on Thursday nights. We play some Grateful Dead. Last week, I had a DJ come on at 10 o'clock, played us out for an hour with this amazing set. We were having a great time. But today we'll be
Wonderful.
talking about earnings. We'll be talking about JP Morgan, some of the banks, some of the ranges. Yesterday really just it altered what some of these stocks were going to do because of that enormous move. But because of these monster candles, I think there's going to be a lot more volatility, and it all starts tomorrow morning with JP Morgan.
Wonderful. All right. Hitsthebid.com, guys. See you.
Email me. I'll see you guys later.
All right. God, I envy him so much. The fact that he can just sit there and just trade off of one indicator and make it work for him all day. So jealous. So jealous. So jealous. And then he can be done by like 11 o'clock. Like, come on. Is that not the life? You trade in the morning for a few hours. You're done. You go play some pickleball. Come back at the close. That's the life right there. All right. Let's bring on today's guest, Mike Singleton from Invictus Research, and talk about what we've been talking about, right? Just get his take on it.
Yo, Jay, we've been friends for a long time. Make the call.
I mean, this is pretty professional, guys.
Nice show you got going here.
Yo, Mike.
Hey, Spencer. Thanks for having me.
How we doing?
Doing pretty good, all things considered.
All things considered, I would say most of us are probably doing a lot better at this time today than we were at this time yesterday. What do you think of all that?
Yeah, crazy market. I guess a crazy market is somewhat to be expected when President Trump is the president and the VIX is at 50. That's kind of a cocktail recipe for wild price action, and yesterday certainly was wild. But I would also say that the conditions, the technical conditions, are kind of in place for a wild market as well. And I'm happy to talk about some of the indicators that we look at. I mean, for one, just when the S&P 500 breaks down below its 200-day and credit spreads break out above their 200-day, we know historically risk-adjusted returns for stocks tend to be much, much worse, and the risk of major drawdowns tends to be much, much higher. So I think there's a Paul Tudor Jones quote to the effect of, when the stock market is below its 200-day, you're playing defense. And I think that's doubly true when you're seeing confirmation across the intermarket universe.
Defense with some spurts of offense in there, though, right? Because because it goes both ways.
I think that's true. You certainly would not have wanted to be short when the stock market was, at 5,100 or whatever, 4,800, whatever it was yesterday before that 10% rally. But yeah, there's a difference between not wanting to be super short, and there's a small difference between not wanting to be short and not wanting to be super long either.
That's right. All right. So what kind of indicators are you looking at?
So big picture, I mean, the major trends in the market, right? The 200-day of the major indexes, the S&P, the NASDAQ, the Russell, the slope of the 200-day, credit spreads, those tend to be our indicators, our best big picture indicators for framing the market from a technical perspective. And from a macroeconomic perspective, the way we look at the world at Invictus is through a growth, inflation, and monetary policy framework. So we want to get a good feel for where those economic variables might be going in the future and how financial markets are priced, and look for dislocations for opportunities. And the reason that we focus on those three indicators is because even though there's more macroeconomic indicators than you could possibly use, the only things that really drive markets are growth, inflation, and policy, and expectations around those things.
Doesn't a trade war kind of throw a wrench into all that economic data, though?
Yeah, it certainly does. And I would say, but I think it will only matter, especially over the long term, to the extent that it actually does impact growth, inflation, and monetary policy. So the name of the game is trying to figure out how this new trade regime impacts the economic data and what's going to happen going forward, and how markets are currently priced with respect to that. I think that prior to yesterday, markets were largely priced as though President Trump was going to follow the Peter Navarro playbook, which is we're going to take the U.S. in a highly protectionist direction, and trade as a fraction of our economy is going to go from, call it mid-single digits, to nothing. And that's going to create a massive short-term drag on growth. And it no longer looks like that's going to be true to the extent it looked like it was going to be true a couple of days ago. It now looks like a lot of what President Trump was doing was a negotiation tactic. And the reason that the market rallied and there was this huge short covering rally is because market participants, I think, realized this isn't the opening salvo to a long, drawn out nuclear trade war. It's the opening salvo to a negotiation, which means the impact on the economy will be less substantial, although, it'll still be meaningful.
But also, like, as we saw yesterday, that could change again tomorrow, next week, in 90 days, right? So do you have to like increase, like, we always talk about how economic data is on a huge lag, right? And you don't see things reflected in the data for months, or in some cases quarters, right? Do you have to like increase that lag a little bit?
I think when volatility increases, it's an acknowledgement by market participants that there's more uncertainty about which way the economic data goes. But generally speaking, the market doesn't lead at the economic data by all that much. It leads by about 3 months. So if you're looking at the relationship between, say, the S&P 500 and the growth data, you can, create a chart of that and do a cross correlation analysis to determine the proper lead time. It's only 3 months. With credit spreads, actually, the lead time is even smaller. It's only 1 or 2 months. And you can do this across the various different asset classes, but it's almost never more than, call it 4 months. So I think that there's a little bit of a misperception. Like there's either no relationship between the economy and the markets, or maybe the markets lead the economy by such a long period of time that it doesn't matter what the economy is doing. And that's not exactly true. Sometimes as the analyst, your expectations about where the economy is going are way off and the market is right. And it feels like maybe there's no connection, but it's very rare that there's actually no connection.
So like, for example, like this morning, we have jobless claims and a jobs number, right?
Right.
Are you paying attention to that?
Yes. I mean, for a variety of reasons, both of those figures are going to, impact the economic data and are sort of inputs into our broader investment process. And, I haven't looked at the data yet, so I don't know which way that they're going. But yeah, I mean, they both affect. Inflation is obviously one of the 3 major indicators that I just talked about. And then the jobless claims data is an input into our growth outlook, because jobless claims correlate with wage growth and obviously the unemployment rate. And it also correlates with both growth and inflation, and it's an important policy input for the Fed. So you have to kind of be on top of the jobs data.
Okay. All right. In terms of the market, aside from the major indices, what and credit spreads, what are you looking at?
So again, the first thing is the primary trend, right? Is the first thing that we look at, which we measure by looking at the 200-day moving average. And then we look at oversold and overbought conditions, because we're basically, big picture, what we're trying to do is we're trying to buy oversold conditions in uptrends. And, when the market's in a downtrend, you're generally trying to get, short or reduce exposure on bounces. And you're trying to, cover your shorts when the market gets oversold. So that tends to be how we think about it. I would say short term, the market was so oversold over the last couple of days. And we think particularly oversold relative to economic conditions. And that's not just in terms of momentum, but also in terms of breadth, which Steve was just talking about, also in terms of a bunch of the positioning data that we look at, also in terms of sentiment. I mean, sentiment was completely shelled. And so when we take a look at all of the different indicators that we look at, we kind of think that the S&P could rally up to maybe as high as 5,700. That said, at 5,700, we think the risk of an acute drawdown would be very high. And, ultimately, we think the risk of a recession is substantially higher than it was a month or two ago. And the risk of, call it S&P 4,600, is certainly much, much higher than it was a couple months ago. But we don't think we're there yet.
So what would have to happen to get to either of those scenarios? Is it like something you have to see in the economic data, or is this just a broad index thing?
So by our calculations, the tariffs as they're described right now will subtract about 100 basis points from real growth in the next, over the period that they're implemented, they'll subtract about 100 basis points in real growth one time, right? And they're being implemented very, very quickly, which the market does not like. There's a slowdown yesterday, which we saw the rally. But look, if you see 100 basis point growth slowdown over the course of 3 months, think about how GDP nowcasts are computed. You take the impact in the quarter that you see it and you multiply it by 4. So you could end up seeing a 400 basis point growth headwind in real GDP in the Atlanta Fed's nowcast and the New York Fed's nowcast in Q2 of 2025. So you will get that reflected in the data. And I think
didn't they just revise it downward like a month ago?
The Q1 data from the Atlanta Fed, I don't think is reliable. We track a bunch of other real-time measures of economic growth, and they're all around 2 and 2.5% for Q1. The New York Fed's economic GDP nowcast is around 2.5%. We think the Atlanta Fed's Q1 estimate will not be right. But Q2 is really where the risk lies. And think about it. The tariffs weren't implemented in Q1. The impact of that will be de minimis, right? Q2 is where I think you're going to see some of the economic data start to suffer. The really big question in terms of the economic data is, will there be second order effects as a consequence of these tariffs, right? Will you see layoffs rise, for instance? I think right now, there's no evidence of that. And our base case is probably not, but we're open-minded, right? Like, markets tend to surprise you to the downside when stocks are below their 200-day moving average, when credit spreads are rising instead of declining, when market leadership is defensive rather than cyclical. So, 4,600 is kind of the place that we're looking now for a longer term bottom. But, we're open-minded. We're also open-minded to the fact that the market could go higher. You want to play the odds. And right now the odds to us look like 5,700 and then lower. But, we'll adjust our opinion as new data comes in.
You see like an equal likelihood of of either happening?
Probably. I would probably say there's equal conviction in both of those calls. I think that if you're not invested right now, I don't know that there's a super compelling reason to go long here for an extra 300 points if the longer term target is down. But, where would we be looking to really reduce net if we have stock? It would be around 5,700.
Okay. Where would that exposure be? Are we talking US? We're talking global, international, all world? What are we talking about here?
So that's with reference to the S&P 500. At Invictus, we're generally US focused. So we spend most of our time analyzing the US economic data, the US financial markets, stocks, bonds, credit, commodities. We do look abroad a little bit, but it's less of a focus. We've really liked China for most of this year, as I think many technicians have. I think China still looks pretty good. China's still overbought within a downtrend. So, at the very least, I wouldn't be shorting the bottom end of this range in China. And, I don't mind having a little bit of long exposure in China here too.
As we were saying earlier, it's actually held up pretty well, all things considered, right? Considering they are now for the moment at least, they're the ones that are in the crosshairs of this trade war, right? So
there's reasons to be bullish. I feel like it's easy because the market is down to be freaked out, but Bitcoin is holding up okay. That's a good sign. Financials relative performance is quite good. That's not something that you see during bear markets. If you look at the performance of credit spreads relative to the VIX, credit spreads are up a lot less. Historically, that's presaged very good returns for stocks. I could pick and choose indicators that look bullish, but I think on balance, the market is telling you, exactly what we said. We think this rally could have a little bit more to go in terms of legs, but we probably wouldn't lean into it.
What does it do to when you get crazy situations like we're in really in the last week, right? Where it's sort of the ground underneath you shifts. Does that impact your process at all? The amount of research you're putting out, the conversations you're having, because things relative to now, things seem really, really calm 2 weeks ago, right? So, does the events of the last week, does that sort of change anything for you, or is it just same old indicators, same old process?
It's the same process, but there's more of a tactical focus. I think that whenever markets do something really quickly, go up or down, usually they go down faster than they go up. Yeah. Your research sort of reorients itself toward picking a bottom, right? Or at least covering your shorts. So, there's an element of that. Clients are definitely more active about pinging me for different indicators and whatnot. I'd say I'm probably sleeping a little bit less. Things are happening overnight. It's a little crazy, but overall, our process, the things that we look at, the data, the historical data, it all remains more or less the same. So maybe we're shifting our view toward very specific data a little bit, but overall, it's pretty much the same. We don't change our process as a result of economic or financial conditions. We just look at maybe different things within our process.
Maybe move a little bit faster as well, because markets are moving really fast right now, right?
Right. Well, I'll say look, I keep referring to these same two things. If you're long stocks 100% when the S&P is above its 200-day and credit spreads are below their 200-day, and then you sell to cash when they're not, sell to cash when one of those indicators breaks, your risk-adjusted return is twice as good as the broader market, right? As buy and hold strategy. So, in this instance in particular, I think you would have been out of the market March 4th, right? It would have saved you a 15% drawdown. Doesn't always happen that way. Yeah. But look, that's to say, sometimes when your intermarket risk indicators trigger, it makes sense to take down risk quickly, right? It makes sense not to wait, and you'll end up missing some upside moves occasionally, but over a very long period of time, right, spanning decades, it's the right risk-adjusted decision.
Assuming you did that, we were talking before about reallocating and getting back in the pool. Are you are you more of a lump sum person or more dollar cost average person, or does it really just not matter to you?
No, I tend to sort of touch up the portfolio and the margins, right? Depending on trend, depending on overbought, oversold, depending on intermarket conditions. That said, I think that there is a time to move quickly and to dramatically cut or add net exposure. I think in retrospect, obviously March 4th was that time, or early March was that time, even though at the time you were thinking like, market structure is okay. We're sort of oversold in an uptrend. But if you looked at the broader financial market complex, it was telling you that something wasn't quite right.
Mike, it's going to be it's been an interesting few months. It'll continue to, I guess it's always interesting, but like things to get more or less interesting based on headlines. And this is a headline driven thing that we are in, and I imagine it'll continue to be so. When there was a great comment yesterday that we in our chat, and then we talked about it on the show about when this is a news driven thing, right? This is a headline driven event that is happening out of the White House. When you get headline driven events like that, the comment was that technical analysis isn't as useful, right? And we had a great talk about that, whether that's true or not. And I mean, my opinion was that I agree, but I disagree, because technical analysis can be extremely useful in times like these. But like, what do you think about that? If you on the one hand, technicals can be your guide. On the other hand, things can happen based on a freaking tweet like yesterday, right? And it just changes the course of everything. So how do you sort of navigate that?
So, I would go back to the definition of technical analysis that JC uses from Edwards and McGee. Technical analysis is the study of markets and market participant behavior, with the hope that studying the past will give you some indication of what the future will look like. And I'll say those two big down days that we had after the tariff announcement were equaled or surpassed only by COVID, the Great Financial Crisis, 1987, and the Great Depression. So I think that if you were pressing your shorts against that environment, you were betting on essentially like a 0.005% outcome, right? That's technical analysis, right? That's looking at market history with the expectation that the future will look something like the past. And I think technical analysis would indicate that pressing your shorts there is a bad bet to make in terms of the skew of forward returns, like the risk adjusted returns of forward returns. So, I think that when you consider, price action, the intermarket complex, sentiment, positioning, I don't know that anything is more helpful than technical analysis. Mark Dow has said, if you gave me just technicals or just fundamentals, I could survive and make money using just technicals. I probably couldn't do it with just fundamentals. And I probably share that view.
As do I. Mike, before we let you run, any specific area of the market you like right now, whether it's sector, industry group, whatever, or even narrower than that?
So, I've talked about these indicators that I think generally show us risk-adjusted returns for stocks are not particularly good. So the stock market is probably not the place we want to be looking. Here's a question, when all of these risk indicators are flashing red for the stock market, where are the asset classes that actually do show good risk-adjusted returns? And this is going to make me sound like a true trend follower and kind of a not as flattering way, but gold. The answer is gold. And gold has already done so well that it seems like, boy, that's a lazy call. But the truth is, gold is an incredibly good asset in terms of diversifying your long-term portfolio. I'll give you another statistic, right? The long-term Sharpe ratio of the S&P going back to 1988 is 0.5. If you do 50-50 gold and stocks, it goes to 0.7. So your risk-adjusted return is 40% better just by adding in half gold. And a lot of stock jockeys don't like to hear that. But the point that I'm trying to make is gold is a fabulous asset for diversifying your portfolio, improving risk-adjusted performance. And if you actually tactically rotate into gold when economic and financial market conditions aren't good, for example, when stocks are below their 200-day, the diversification benefits of gold improve dramatically.
All right. Damn. I didn't know that about the Sharpe ratio. That doesn't sound right to me, honestly. Just because of what I know about the performance of stocks, but I guess, yeah, I mean, I believe you. So,
I might tweet it out later, and you can correct it if you see any errors.
I mean, I haven't done the work, you have, right? So that's a pretty remarkable stat. honestly, to hear that 50-50. I don't think anyone actually has that. So
right. And I'll qualify that by saying your absolute return will be about 200 basis points lower, if I'm remembering right. So your
that's more like it.
Right. But your max drawdown goes from 57% to 33%, which I think a lot of people, 57% is, you're going nuts. 33% is much more manageable.
Yeah, it also depends how often, right? But all right, Mike Singleton, Invictus Research. Mike, this has been great, man. Thanks for coming on.
It's a pleasure. Thanks for having me.
All right. It is 9:23, and we want to get off the show by the open. Give Steve I know Steve has been in the background, either looking for trades and or guzzling coffee, so that he's ready to go live at 9:45. We've been having a lot of fun this week doing that. I think maybe we'll do it more. I don't know. We'll have to see. But yeah, Steve's going live at 9:45. He'll have Sean pop in as well, because we like hearing from Sean on Thursdays. And usually we have Sean on the morning show, but we're going to end early today. So that's the plan. Steve, just your camera's off. I can't see you. Turn your camera on and I'll be able to see you on here. But yeah, okay. That's the plan. Let me just look at the market real fast. How are things doing since we've started? Kind of the same, right? Futures all pointing down. It's been a somewhat uneventful morning. Or maybe Steve is prepping for the Masters. That's what he's probably doing right now. He's probably looking for trades, guzzling coffee, maybe a croissant, and prepping for making Masters prop bets right now. I don't know. He'll be back in a second. We'll find out. Before I forget, today is a very busy day on the Stock Market TV channel. So as I mentioned, we're going live at 9:45. If you are a member of Breakout Multiplier, you will get the weekly strategy session with Steve. That is at 11 o'clock Eastern time. Sean does his options jam session Thursdays at noon. So you've got that. Programming note, for the time being, we are only going to be doing Chart Request Live once a week on Mondays. So we've been doing it Mondays and Thursdays, but we're going to be doing it just on Mondays for now. So no CRL today. But at 2 o'clock, Jason and Sam are going live to do Gold Rush. That's at 2. And then Jeff Mackey will be recording a video for his members later on, as will Louis Sykes, who will be doing a thing for his crypto people at 7 o'clock. So what's going on the channel today? Strazza, how are your Masters prop bets looking?
Okay. It's either going to be Scotty or Rory, but I got the kicker on Angel Cabrera.
Didn't he win like 20 years ago?
Yeah. He's out of jail now. He's back.
He was in jail?
Yeah.
Like he was in prison.
Yeah. 3 years or something. Masters champ. One of the greatest of all time to play Augusta. I'll have you know. Remember that? God, it must have been 15 years ago now. But he had a playoff with Adam Scott back in the day. I mean, it was epic. I had money on him back then too. I'll never forget it.
All right. That's not a name I've heard in a very, very long time.
Angel Cabrera. Also, like some of the odds, the futures odds, you could do like $1 to win 1,000 on some of these guys. Even like Lucky Lefty, Mickelson. You got some juiced odds out there. Long shots for sure. Is Daly playing?
Dude, you're the golf guy. I ask you the questions. You don't ask me the questions.
Nobody really talks about whether John Daly's, playing or not, but I wonder. I always wonder. I
get my golf knowledge through you.
Oh, he never won the Masters, did he? He won the US Open.
Dude, I don't know.
Yeah. So we're going live in about 15 minutes here. You see this Testani guy in the chat? No idea what he's talking about. Strazza, maybe you are the one who does not understand tariffs and deficits. It is the U.S. that has most benefited from the world trade. Yeah, no shit.
I think, yeah. Right. That's pretty. Yeah, I think we all agree with that.
Yeah. No, that's very true.
We are the most prosperous country in the world.
Wow.
For a reason.
Who knew? It's not about that. Right. I don't know what that has to do with renegotiating trade deals. I don't understand. I had
one thing to say about the insider trading stuff. I saw a lot of that yesterday. He tweeted and then he announced. And look, Was there insider trading yesterday? I mean, there could have been, sure. I mean, there probably was, if I'm being honest. On the list of things to be pissed off about, that's at like the very bottom of the list, right? First off, Trump did say to buy. It doesn't mean you necessarily listen to him, but like he did give you a warning. And also, what was stopping you from buying yesterday? If you were in front of your desk, in front of your screens, or in front of your freaking phone, you could have bought. You had all day to buy yesterday, right?
I bought into the madness. I'll be buying more today on this dip.
Right.
Glad we're getting this red open.
For the people crying about, oh, they did insider trading and
shut up.
Maybe they did, but like maybe they did, but this is such a small issue in the grand scheme of things to be mad about. Like Steve has done the research. Ask him. He knows that the smart money in Washington, they're not actually all that smart, right? Like they have more information, but they're not better traders.
Listen, here's the truth about that. That was fun. It was funny. Kenny makes an excellent point. Other presidents would have done this in the after hours. He did it right during market hours. Retail could participate. Okay. Good for him. Live a little. Okay. People who are complaining about this, have some fun out there.
I don't think anyone in the chat is. I'm just speaking really.
Oh, I've seen it.
Okay. Look, I just think if you're going to cry about this, then participate. That's the bottom line, right? Okay. That's all I wanted to say.
It's kind of like saying, oh, the market's rigged. I'm going to take my ball and go home. Or you could say, the market's rigged. Let's get it.
Or you don't even have to play the game. If you're just fully invested forever, then you're not even in the game. You're playing a whole different game right now, which is totally fine. That's acceptable too. But don't cry about that. That's stupid.
Thank you, Lauren Ratliff. You're right. Nobody's going to the SEC website to check the definition of insider trading. Though.
But
absolutely nothing that happened yesterday was illegal in any way.
That's exactly that's a great point. Great point.
He's the president. He could do whatever he wants.
I'm speaking to the idiots out there. Lauren is not.
Spencer, there's one thing to do after the price action like we had yesterday. Okay, coming off exhaustion with thrusting, it's go time. There's one thing to do right now, and that's look for what we should be buying. Okay, and that's what we're going to talk about in 15 minutes.
Let's do it. Thank you for watching. Thank you, Mike. Thank you, Kenny. Thank you, chat. Smash the like. We will see you. Oh, you know what? Actually, before I end the stream, let me make sure that it'll redirect you automatically on YouTube. If you're watching us on Twitter, as I said, it'll be there. If you're watching us on our site, it'll be there as well. Stockmarkettv.com. I don't want to end the stream yet until
we're going to be quick. Spencer, we're going to be in and out 15 minutes. It's a fast market. We got trades to make. Okay, so we're just going to run through them rapid fire through ideas. Man, do I have some dope charts.
Yeah,
I got some themes too. I got some themes. Have you seen 2's 10s? Seen 2's 10s? You know, bank earnings. Bank earnings tomorrow.
That's right.
Little bank earnings. How you doing?
All right, we'll see you guys in 15 minutes. All right. Thank you.
Bye, everybody.
I can't take no loss.